Institutional investors chase alpha, like Wall Street interns seek validation from bosses who barely know their names. In recent years, these trillion-dollar funds have obsessed over one surprising asset class that's not what you'd expect. It's not stocks, not crypto, not real estate, and definitely not artificial intelligence taking center stage. This industry has grown tenfold since 2007, creating a fresh batch of billionaires in the process. It sounds so dull that it makes municipal bonds seem downright sexy by comparison. We're talking about private credit, the quiet giant now worth over $2.5 trillion globally. For context, that's bigger than Canada's entire GDP, though let's admit that bar isn't set too high. Private credit has matched stock market returns over the last 20 years, but with much less volatility. Imagine stock-like gains without the wild emotional swings that keep investors up at night. So if private credit is this amazing, why do so few outside Wall Street even know it exists? That mystery drove me to investigate this secret industry reshaping Wall Street for 2 full months. You might have heard about private credit from a finance bro in a Patagonia vest clutching a Red Bull. But if not, here's the simple breakdown. Companies need loans to grow and survive tough times. 30 years ago, you'd stroll into a bank, high-five a banker named Tucker, and get your loan easily. No deep checks on credit scores or income, even if your last venture was a flop like a failed coffee shop. Loans flowed faster than gossip at a family reunion, leading to massive risks building up unnoticed. And that carefree lending sparked the 2008 financial crisis, nearly collapsing the global economy. Picture families in Ohio losing homes because banks bundled bad debts into ticking time bombs. After the crash, banks became strict like overprotective parents enforcing new rules and regulations. Now, getting a bank loan means endless forms, collateral offers, and begging for approval. That's where private credit enters as the flexible alternative, like a helpful uncle with cash ready. Companies borrow from non-bank lenders such as Blackstone, Apollo, or Ares for direct loans. These firms charge higher interest rates but provide quick funds without the bank's red tape. It's similar to Venmo, but instead of $20 for pizza, it's millions for a struggling refinery. You have guessed what this industry is yet? Comment number 1 below if you're still curious. Why does private credit thrive so much in today's market? Finance always fills gaps left open. Back in the early 2000s, private credit was tiny, around $140 billion globally, mostly ignored. It was the awkward sibling to private equity, niche, and not drawing much attention then. Then the 2008 crisis hit hard, with banks dishing out loans like candy on Halloween. They offered infamous ninja loans to folks with no income, no job, and no assets whatsoever. Banks bundled these risky debts into collateralized debt obligations, or CDOs, sold as safe investments. For clarity, CDOs are packages of loans turned into securities, often hiding underlying dangers. They even created CDO squared, essentially bombs wrapped in fancy financial packaging. Unsurprisingly, it all exploded, wrecking economies and leaving millions in financial ruin. Regulators stepped in post-crisis, forcing banks to boost reserves, cut leverage, and tighten standards. Lending to small and medium-sized companies became too risky and headache-inducing for banks. By 2010, traditional bank loans to these middle-market firms had dropped dramatically. Yet these companies still desperately needed capital to operate and expand their businesses. They were too large for local community banks, but too small for Wall Street bond issues. Private credit funds swooped in, saying, "Don't worry, we've got your back despite the banks ghosting you." Forget heavy collateral. Just agree to 10% interest and some fees, and funds flow. Companies jumped on it quicker than shoppers at a Black Friday sale in New York. Take a family bakery in Ohio, hit by rising costs after the crisis, struggling to stay open. The local bank denied their loan due to new rules, leaving the owners feeling hopeless. Then private credit provided quick funds, saving jobs and keeping the community bakery alive. Stories like this show how private credit fills real gaps, helping everyday Americans thrive. In 2010, private credit assets were about $300 billion, but by 2020 it topped $1 trillion. Since 2007, it's exploded over tenfold, becoming Wall Street's go-to money-making machine. Over 20 years, private credit returned around 9.6% annually, solid and reliable. Meanwhile, the stock market gave about 10.2%, just slightly higher over the same period. So why do investors obsess over private credit if it slightly underperforms stocks overall? It boils down to 2 magic words that excite every finance enthusiast: stable returns. Private credit offers gains without the wild swings that stocks deliver unpredictably. Stocks might surge or plummet 20% in a week if Fed Chair Powell speaks. But private credit stays smooth, boring, and consistently delivering those steady profits. After years of low interest rates where bonds yielded almost nothing, this is gold. It's too risky for banks, too safe for hedge funds, perfect for pension managers. With 30 trillion in assets, endowments find it the ideal middle ground investment. Equity-like returns with bond-like stability make it seem almost too good sometimes. Money always finds a way to flow, even when traditional paths close unexpectedly. Think about patterns in history. Private credit echoes past booms but with more safeguards. Unlike the dot-com bubble, it focuses on real lending to tangible businesses today. Many mistakenly think private credit is only for the ultra-wealthy elite investors. But it indirectly helps everyday companies like that Ohio bakery we mentioned earlier. Do you believe private credit can truly save small businesses? Share your thoughts in the comments. At 3. However, private credit isn't perfect. It comes with its own hidden risks lurking beneath. Key issues include liquidity problems, unclear mark-to-market valuations, potential defaults, and leverage concerns. There's no central exchange, no easy liquidity, and no public quotes for these loans. Nobody truly knows a loan's worth until borrowers stop paying, turning it into guesswork. That's Wall Street's charm. Ignore cracks as long as 8 to 10% returns continue. Tatun. The industry assumes borrowers will always pay, and for a decade they mostly have. But what if regulations had stayed loose post-2008? Would private credit have grown this big? Perhaps not, but hindsight shows it filled a vital void in the financial ecosystem. A common misconception is that private credit is risk-free compared to stocks entirely. In reality, during economic downturns, the defaults could spike, shaking the whole sector. Imagine that Ohio bakery facing another recession. Could they keep up payments then? These stories remind us finance affects real people, not just numbers on screens. We must approach it with empathy, understanding the human impact behind every loan. So, is private credit Wall Street's hottest innovation or just another disguised bubble? Maybe it's the latest trend in a different suit, waiting for the music to stop. The truth is uncertain, and only time will reveal the full story ahead. For now, Wall Street profits roll in, and questions remain politely unasked. As long as payments continue, the party goes on without much scrutiny. But let's pause and reflect. Money flows. But does it always flow wisely? We've explored this secret industry, from its roots to its risks today. Private credit offers opportunities but demands caution in uncertain economic times. Think about your own experiences with loans or investments in everyday life. Sharing these stories builds trust and helps us all learn together genuinely. If this sparked your interest, consider subscribing for more finance insights like this. And don't forget to like and share if you found it helpful or eye-opening. What do you think? Will private credit be the next big bubble? Comment 1 if yes, 0 if no. Your opinions matter and help shape future discussions on this channel. Thanks for watching, and stay curious about the world of finance around us. Remember, knowledge like this empowers you in your financial journey ahead. See you in the next video where we dive into more hidden gems. Until then, keep questioning and exploring the markets with open eyes. Finance isn't just numbers. It's stories of people and possibilities unfolding. We care about making complex topics accessible and relatable for everyone. Your feedback drives us to create better content tailored to you. So drop a comment and let's connect over these intriguing financial tales. Private credit might change how we think about borrowing forever, but always weigh the pros against the potential pitfalls carefully. In the end, informed decisions lead to stronger financial futures for all. What corner of finance should we investigate next? Let me know below.